Once we go to ratio analysis,
the types of analysis.
Yes, maybe.
You should go to the types of analysis. We go to ratio analysis.
Okay. So last week we were discussing financial statement analysis, and we mentioned to you that we're doing financial statements. We try to determine what the relationship among the financial statement items. And if we do it over a longer period, we're trying to establish whether there's a trend. Now we look at the standards that are there to do the evaluation. We also look at the sources of information. Then we began looking at the techniques. So we discussed horizontal analysis for 2 years, and we said if we have a number of years data, then we can extend it to more than 3 years, more than 2 years, and we can say trend analysis. Then we also looked at vertical analysis or common size analysis. Then we were discussing ratios, and we explained that basically we can have 5 type of ratios, and each of them will determine some specific aspect of an entity. So we mentioned that we can have those that can help us evaluate whether an entity is able to meet its maturing needs, which we refer to as liquidity. Then we list activity ratios, solvency ratios, and profitability ratios. Then we said that if we look at profitability ratios, some of them are specialized, and some of them are used to analyze the shares of a business as an investment. So we can separate them and consider them as investment ratios. Is that what we got to when we left? We started looking at liquidity. Where's the cash rate? Patrick, where did we get to? Patrick, let's see, where did we get to? Nobody will talk in the class. Yes, Bismarck.
Sir, please, I'm having a challenge with your voice. It keeps going up and down. I don't know whether it's from my end.
I wouldn't know.
Prof, we've got to analyzing the financial statement. Yes. Look at the vertical and horizontal.
Okay, so one of the ratios that we want to look at is liquidity. And liquidity has to do with ability to pay unexpected needs. So if an entity may have current obligations. So the current obligations will include payment to suppliers, payment to employees, and so forth and so on. So they are looking at liquidity. whether the entity will be able to meet those debts as and when they fall due. So if an entity can meet its maturing dates, then we say that that entity is liquid. But if the entity cannot meet its maturing dates, then we say that that entity is illiquid. So remember that liquidity is a short-term measure, ability to meet maturing dates. Now, when we are looking at liquidity, we are basically looking at the middle portion of the statement of financial position. So it is the middle portion of the statement of financial position that we use in liquidity. The middle portion has to do with your current assets and your current liabilities. So we are looking at how your current assets cover the current liabilities. How your current assets cover your current liabilities. Now, we have three main ratios that can be used to evaluate liquidity. We have current ratio, quick ratio, and asset test ratio. So if we're looking at current ratio, we're looking at how the entire current assets can be used or can cover the current liability. And we are taking out inventory and how the rest of it can cover current liability. And if we are looking at asset test ratio, we are looking at how cash and near cash items or cash and cash equivalents will cover current liabilities. Now, we mentioned that if we evaluating liquidity, we are looking at how the current assets cover current liability, and we try to refine the formula as we go along. The reason why we find is we want to determine the liquidity of the assets and the valuation of the assets. So there are two main conjugations. Liquidity of the asset has to do with ability to convert it to cash. So if you look at the current assets, some of them are very easy to convert to cash. Some of them are cash, and some of them are very easy to convert to cash. For others, it is difficult. So for others, it is difficult. And therefore, we can now separate the current assets, looking at those that are easy to convert to cash and those that are difficult to convert to cash. Then the next consideration has to do with valuation. And valuation has to do with assignment of monetary amounts. So we're looking at how true amounts of the assets can be realized, because we are looking at ability to pay your maturing debts. So if your creditors or those that you owe or you pay come, the figures that we have stated in the statement of financial position, can we realize them? So that has to do with the valuation, or how exact amount that we have stated in the statement of financial position. So basically, we are looking at liquidity and valuation. So for instance, if you the inventory may have a challenge with inventory in terms of liquidity and in terms of valuation. So in terms of liquidity, it will take a very long time for us to convert inventory to cash. So its liquidity cannot be guaranteed. First, you have to sell them and generate account receivable and collect the account receivable. So the liquidity will take a long time or take some time before you can inventory to cash. Then when it comes to valuation, there are difficulties with the amount that is stated. Sometimes there are difficulties with the amount that is stated in the statement of financial position. And the difficulty one be because the entity used a method of valuation that increases the inventory value. So for instance, we have several methods to value inventory. we have the first in, first out, which we call FIFO. The last in, first out, which is called LIFO. We have the average, and even the average, we have the weighted average, we have simple average. Now, depending on the changes in prices, the valuation methodology that you adopt, two entities may return different amounts. Now, so the issue is that a true amount? Sometimes you may have slow-moving inventory, and because you have slow-moving inventory, it may be very difficult to now say how much we can realize. Sometimes you may inventory that have been captured, but they are obsolete, so they are just occupied, and there are no real values on them. So when it comes to inventory, we have difficulties with their liquidity and valuation. If you pick account receivable, yes, account receivable can be factored. That is to say, you can sell the account receivable. So if you have an account receivable sitting in your books, you may decide to sell it to another entity. But they are going to factor it or sell it. We're not sure how much you make. You could factor it as say 90%, 80%, 50%, depending on the quality of the account receivable. So because of that challenge, we are not sure about the valuation. When it comes to even the liquidity, by definition, account receivable should be converted to cash within one business cycle or within one business year, whichever is longer. But for some account receivable, it's been there for several years. Because those ones are all collected. So we have difficulty with pushing liquidity. Now, so as you refine the methods, or you would have paid electricity in advance, which is a current asset. So if you have paid electricity in advance and your Ghana Water Company has come to collect their debt and say that let me go to BCG and collect my money and use that to pay, that's a very long time. So we are not sure of these points. And so when it gets to some points, then what you look at will be cash and cash equivalents. So cash equivalents or near cash items are assets that can be converted to cash easily and at minimal cost. So we are looking at assets that can be converted to cash easily and at minimal cost. If you read some books, they will say that the net asset minus stock is asset ratio. But if you read them, you get that. Don't get confused. This is what we are using. Now, any question? Any question? Any question? Okay. Now, when we talk of liquidity, we are looking at ability to pay maturing debts. So, if you're looking at your ability, you are also looking at the probability that you default in payments. So, now let's look at the factors that may affect your ability to meet your maturing debts. There are certain factors that may affect your ability to pay your maturing debts. These factors may be prevalent in an economy. So every entity operating within that economy may be affected. So it can affect every entity's ability to pay their maturing debts, or majority of them to pay their maturing debts. So such factors are referred to as economy-wide factors. So they are not limited to an individual entity or to a group or an industry. An example would be inflation. When there's inflation, it reduces the purchasing power, and therefore it affects your ability to pay your maturing debt. Yes, Bismarck.
Please, can you throw more light on the cash equivalent? Since I didn't get that part.
Okay, we'll come back to it.
Okay, sir.
So we're looking at factors that will affect an entity's ability to pay their maturing debts, and I'm explaining to you that some of them are economy-wide, so they will affect every entity operating within that economy. Can you give an example? An example. Are you guys in class?
Yes, sir.
Yeah.
Yes, sir.
Yes, sir.
But do you understand the explanation that I'm giving you?
Yes, please.
But you can't think of an example.
I've said inflation. Hey, it's even there. Okay. Foreign exchange at appreciation and depreciation.
It will affect every entity.
So government policy.
Government policy. Can you give a specific government policy?
Like let's take in the banking sector. When the reservoir of the banks were increased, it just go along with the effect. And when loan rates.
Hold on, Jaman. So if government decides on the capital for banks, it will affect every entity within the country.
So what about minimum wage? Minimum wage also affects.
Okay, so we have industrial factors. So here the factors are specific to an industry. So if you operate within that industry, then you may be affected. Then we have firm-specific factors. It are those that affect just an entity. So if there's a natural disaster affecting one company, then that will be firm-specific. So if there's flood or there's fire, something of that nature, it will affect your ability to pay your insurance. Yes, Theophilus.
So please, where would we place a pandemic like a pandemic, something like the coronavirus? Where would we place it?
It's more of
affecting every aspect.
It's more of economy-wide.
Okay, thank you, sir.
Because it will affect majority of entities operating. Of course, those that have businesses that are booming because of the pandemic, they will not be affected. But if you look at the majority of entities, or if you look at the economy, majority of companies are bleeding because of the pandemic, because of the restriction, because of the
Thank you, sir.
Yes, learning.
So then what about currency depreciation?
Okay, so
Like
when there's
if-
what does it lead to?
Let's say there's the value of the currency is being reduced, like internationally, it loses its value. Is it not going to affect?
Who is
Sorry. It's really
no? Who is reducing it internationally?
sorry. I don't have anything to explain. I'll think about the writing.
And if talking about where the currency depreciates. There is equivalent to inflation. Okay, all right. So these are the factors that may affect an entity's ability to pay their mandatory debts. Yeah, this man.
So please, what about tax increments?
For every entity or government directed policy?
Government policy, as in we have increased tax.
Okay. So that will also affect, because when taxes are increased generally, it takes the purchasing power from the businesses. So instead of they having the money to deal with it, the money is taken out, and it will affect their trades or their business, and therefore their ability to pay their majority. But it could be a government-directed policy to an industry. So if the government decides that they are taking, or they are doing a special levy for the banks, or a special levy for maybe the mining companies, then it could be an industrial wide. All right. Now remember, we're talking about liquidity. We are looking at the middle portion of the state of financial position of the bank. We're looking at working capital. Now, when it comes to working capital, an entity may have a policy regards to this working capital, and the policy will consider how how their current assets are financed. Now, an entity may decide that they will match the maturity of the financing of current assets with the maturity of the assets. Maturity of the assets has to do with when the transaction is complete and receipts are received. Okay, so if, for instance, I'm going to buy water, I'll be looking at when I get the money to buy water, and how long will it take for me to pay back the water, the money that I collected at the water. Now, if I buy the water, how long will it take me to receive back, i.e. to sell and receive the money back? So if you look at the duration within which you sell and receive the money back, we refer to that as the maturity of the assets. But when I have to pay back, that is the maturity of the finance. Okay, so assuming you are in school and you are interested, you want to go to school and you want to pick an overdraft to go to school, hoping that when you complete school, you get a pay rise and be able to pay back. So there's a mismatch between the maturity of the financing and the maturity of the assets, because it will take a minimum of 2 years before you complete school. But if it's an overdraft, then you expect that within a year you should have paid back. Now, so when we are looking at the working capital capacity, there are three main policies that an entity may subscribe to. They could be moderate, aggressive, or conservative. Now, if the entity is practicing a moderate working capital financing policy, it means they align the maturity of their assets with the maturity of the finance. That is to say that when the financing is due, the asset has to mature and it's cash, so you can use that. We may refer to this as a perfect pitch. So that is the moderate. Solomon, be careful. So if you align the maturity, or if you match the maturity of the asset with the maturity of the financing, we say that it is a moderate kind of working capital financing policy. The financing, the maturity of the financing is shorter than the maturity of the assets. That is to say, when the financing is due, the asset is not matured, they will say that it is an aggressive kind of working capital financing policy. It's an aggressive kind of. So, I think you take that and the overdraft is due in 6 months, and you decide to build a factory out of it. So by the time the overdraft is due, I'm sure you will have finished with the substructure. So the financing source will be shorter than the maturity of the assets. Then we have the conservative. The conservative here, we are looking at where the maturity of the asset is shorter than the maturity of the finance. So it means by the time the asset has matured, the financing is not due. Especially if you decide that you are using permanent capital for short-term assets or temporary assets. So you want to, you're always going back to your shareholder asset to bring in for your working capital. That would be an example. Any question? Any question? Yeah, this man.
So please, with the aggressive, is it possible, since an overdraft is given to a person based on the ability to pay on time, and in this case the person wouldn't be able to pay since the assets wouldn't be due before the overdraft time? So how do you solve this issue?
Are you asking me or you asking the class?
Sir, please, anyone can help.
Okay. He's asking whether it is possible. It is possible. Because many a time, people will take facilities and they will divert it. In the time past, most of you are young, but if you went to the status where you see a lot of factories that are uncompleted. Because during that time, long-term finance in Ghana was non-existent. Everybody was granting short-term to go to once overdraft to go and buy sugar from Brazil. Want to go and buy corn from Botswana and all that. But there are people that have dreams to build factories. So they'll go around it. And even now that the banks are closely monitoring how finances are used and all, people still divert. So it is possible. Okay, so now if that is done,
Sir, please, can this one be some part of like the causes of how some of the banks are closing down?
Well, they are myriad of causes.
Okay.
Most of the issues that affected the banks had to do with governance. It's the issue of governance.
Okay, sir. Okay.
Now, so if you, I'm asking the question that is an entity takes a facility from you, and instead of a short-term assets, you go and they have invested in a long-term asset. Which means that when the time is due, they cannot pay. what will you do? But is the holiday affecting you or what? Andrea?
So you can assess the viability of the investment to see whether it makes sense to business.
Okay. So for many businesses, what they do is that after assessing and if it is viable, it means they have to refinance it. It means you have to give them more money. Okay. You have to refinance it. You have to convert it to the short-term credit to a long-term credit. But the money will not be enough. So you have to give them extra money. Okay. Any question?
Prof,
Jamal,
Hello?
you have labeled yourself as Jamal's colors, so you can't ask a question or answer a question. Okay, now let's go back to the ratios. We said that basically there are three ratios that we are looking at. So current ratio, quick ratio, and asset test ratio. Now, when we look at current ratio, we're looking at how the current assets cover the current liabilities. It may be stated in percentages. It may be stated in the normal ratio, so which will be assets is to current liabilities. So 200% or 2:1, or in the form of a fraction, or whatever ratio that you want to represent them in. So if we have more current assets than current liabilities, then it means that the entity is liquid. So for instance, in an industry, it could be current assets should be 2 for every 1 current liability. So the standard would be 2:1. And remember that when it comes to the ratios, the industry standards are specific to an industry. So what prevails in an industry may not be appropriate for another industry. Now, if you have more current assets than current liabilities, so say 2:1, then we say that the entity is liquid. But if you have 0.8:1, then it means that for every CD of current liability, you cover it only 80% or 80%, which may mean that you are illiquid. So when the ratio is high, then it is good. 2:1 is good. When the ratio is low, it is bad because you are not covering your current liabilities. However, when the ratio is too high, then it may mean that the entity is inefficient. So for instance, if there's an industry where the standard is 2:1, but you have 5:1, it means that you have a lot of surplus assets and that your assets are not being utilized. So even though it will be a mark of liquidity, but it will also show that you are inefficient. The assets are not being used. So when the rate is low, it's bad. When it's too high, it is bad. Now when it's high, it is good. When it is low, it means that you are illiquid. When it is high, it means that you are liquid. When it's too high, it shows that you are inefficient. What are some of the assets that we can think of as far as the current ratio is concerned? Current assets. What are the current assets? Yes, James.
So inventory.
Obviously. After that.
Sir, please, cash at bank.
Okay, all right. Okay, and many more. So when we look at quick ratio, remember that we are taking out inventory or stock. And I've explained to you the challenges that we have with stock. because of the liquidity and valuation. So if we take out we take stock or inventory out of current assets and look at how it covers current liability, then we are looking at quick ratio. Okay, we are looking at quick ratio. Now, the quick ratio is a refinement of the current ratio. So we're looking at how we are closer to using assets that can be converted and its coverage of current liabilities. But when we look at asset test ratio, we are looking at cash and near cash items. And remember, I explained to you that when we are looking at liquidity and we are looking at the assets, there are two key concepts. So we are looking at liquidity, and liquidity is ability to convert to cash, and valuation, how close we are with the amounts that have been stated in the statement of financial position. So when we talk of cash and cash equivalents, the cash equivalents are assets that can be converted to cash easily. So it satisfies the liquidity requirements at minimum cost. So it satisfies the valuation criteria. So when we talk of cash equivalents or near cash items, we are talking about assets that can be converted to cash easily and at minimal cost. So if we convert to cash easily, then we are satisfying the liquidity criteria. And if we say that at minimal cost, they satisfy the valuation criteria. Can you give examples of assets that can be converted to cash easily and at minimal cost? Can you think of any? Yes, no? Okay, so that's an assignment for you. You are required to list and explain 4 items that are classified as cash equivalents or near cash items. And submission is 2 o'clock a day. So you put it to your class rep, and your class rep will now send it to you. So class rep, I need to receive it by 3 o'clock today. Okay. Any question?
Hello, sir.
Yeah, this one.
Sir, please can you repeat the assignment?
Yeah, sir, identify 5 items in a statement of financial position that may be described as cash equivalents, and explain why they should be classified as cash equivalents.
Hello, sir. Please, can you repeat it? I didn't get the last part. Sir.
I am not repeating it. I've said it 3 times. I'm not repeating it. And Andrews, you are saying that you have a class after this, and so what? You have a class after this, and so what? So you won't do the assignment. Andrews.
So we are just reading that you review the time for an hour class.
Hello?
I said give it to your class by 2 o'clock. And I don't want you to ever make such a statement that you have a class after, so you will not do that time. You have the class up to what time?
The class will be done at 11:30.
They can't.
It's 11:30 to 1:30, please.
So after what do you have?
So after this class, our next class is 11:30, please.
So why are you saying that you have a class after this?
No.
We are sorry, we'll do it.
Okay, everybody should meet themselves. Mute yourself before I take you out of the class.
Slowly.
Elizabeth, why will you take 2 o'clock a.m.? Why will you make such a suggestion? Yes, I'm waiting for a response from you.
Sir, please, I wanted to be sure. That's why. I'm sorry.
To be sure that the assignment is due 2 a.m.
I'm sorry, sir.
Okay, so when we are looking at profitability, we are interested in determining whether an entity is making a satisfactory return. So if we're evaluating profitability, we are looking at any activity that increases revenue. So here, if anything or any activity has the potential of increasing revenue, then it will come into the measure. Or if any activity has the potential of reducing expenses or costs, into the measure. But let me explain to you that all things being equal, profitable firms are also liquid. All things being equal, profitable firms are also liquid. When you make profit is creation of wealth. So when you Solomon.
Oh, sir, sorry, please.
This is the 5th time. The next time I will beat you from the class. Will you mute your microphone? So when you make profits, it creates wealth. And if you create wealth and part of the wealth is current assets, then you'll be liquid. So all things being equal, profitable firms are also liquid. Profitability is linked or closely linked with liquidity. However, it is possible that entities that are profit-making may be illiquid. Can somebody explain to us why an entity may be profitable and yet illiquid? Yes, James.
Yeah, sir. When it locks up a lot of capital in assets that cannot be easily converted to cash.
Okay, great.
Cash equivalent.
Okay, so when you make the profits and the profits are used to acquire non-current assets, then that is possible. But it is also possible for an entity that is loss-making to be highly liquid. It's also possible for an entity that is loss-making to be highly liquid. James, do you still have your hand up?
Yes, it's possible.
Yes, can you give us a paint a scenario?
Yeah, when especially when they are selling a lot of asset, machinery and those things, and converting them to cash to pay some of their current liabilities.
Okay. Any others? Any others? Any others? Any others? Yeah, Jamal.
So what about a firm that has gone into an investment, a long-term profitable investment?
Such as?
Maybe bond, which is going to mature, and maybe a long-term bond, probably.
But the coupons are not paid.
Pardon?
The coupons are not paid. The interest.
Yeah, when the interest is great.
Okay, all right. Now, when we are measuring profitability, remember, yes, President. Yes, President. You are muted. Okay, so when we're measuring profitability, remember, we're looking at any activity that will increase revenue or profit. So some of the ratios that we use are the margins. So the margins, basically, we have two of them. We have the gross margin and net margin. So gross margin, we are looking at profit as a percentage, gross profit as a percentage of sales or turnover. The net margin, we are looking at net profit as a percentage of sales or turnover or revenue. Now, when we're discussing common size analysis or vertical analysis, we did discuss the margins. So here we're looking at the relationship between gross profits and net sales or turnover or revenue, whatever is used to measure the Now, when we look at the gross profit margin, we are looking at the proportion of the revenue which is retained to help defray or cover expenses and the retention of net profits. And usually we see that for every business, if a business is making gross profits by making net losses, it means that business is potentially viable, and that all you do is to look at how to manage the expenses and you return to profit. So we're looking at how, or the portion of the revenue which is retained. So if you take out the direct costs, the portion which is retained to cover the expenses and therefore the profit. Then we have the net margin, which is the bottom line. So we are looking at the bottom line. So the bottom of the profit which is retained. So if there are two entities and one is retaining more as compared to the other, then the entity that is retaining more is generally more profitable than the entity that is retaining less. Then we have asset turnover, and here we are looking at the relationship between your assets and your turnover. So we are looking at how you are using your assets to generate sales or revenue. So an entity, and it is measured in number of times. The margins are measured in percentages. The asset turnover is measured in number of times. So we look at the times that you are using your assets to generate sales. So if you use your asset to generate sales several times, then it is a mark of efficiency. It means that assets are not idle, that you are using the assets to generate revenue. And as you generate more revenue, then you can cover your expenses and make profits. And that's why it is one of the measures of profitability. Then we have return on assets. Return on assets measures the overall earning power of an entity. And usually it's a combination of two ratios. So here we are looking at the asset turnover and the net profit margin. So we're looking at how, and it's also measured in percentages. So we're looking at assets. If the asset is efficiently being used, then the profits that generated from it will be high. And we have return on equity. Return on equity measures the relationship between owner's interest and profit. So we are looking at the profit that is attributable to shareholders and shareholders' investment in the business. So if there are two entities and one is returning a higher ROE, that is more profitable than the other. Now, when you are doing ratio analysis, what you do is you need to decide on a ratio that you want to do the analysis. Once you decide to decide on the ratio, the next is to look at the formula. If you look at the formula will include certain variables. And once you have those variables, the next is to define those variables. Because the variables may mean different measure. Now, once you have defined the variables, then you can go ahead to compute the ratio. And once you compute the ratio, the next is to interpret the ratio. So it is important that you define your variable. Now let's come back to the profitability ratio. So the first one that we're looking at is return on asset. And remember that we say return on asset is usually measured in percentages. So to be over 2 times 100, because we measure it in percentages. So we have identified the formula. Now it's left for us to define the variables. So we have net income and we have total assets. What is our definition of net income or net profit in this context? What do you think is the definition? What should we say is net income or net profit? And what do we say is total assets? Hello? Yes, Matilda.
Please, net income is total income received minus total expenditure.
So if you look at the structure of the profit and loss account or statement of comprehensive income, which one are you talking about?
Okay, net income is total income minus total cost of production and expenditure.
Okay, anybody else? Anybody else? Anybody else? If you unmute your microphone, the assumption is that you're going to respond. So if you mute your microphone and you just providing background to the short class, I'll remove you from the class. Yes, Randy. Yes, Timmy.
Net income is the amount you earn before tax and other payable this thing is being deducted.
Yeah, Jamal.
And that should exclude tax and other payables.
See, the challenge that you people have not read and you have not acquainted yourself with the financial statements. And that's why we're having the challenge we're having today. It's like you simply don't care about what we are doing. Anybody else? Anybody else? God asks you to pick an annual report and look at the structure. You have gone through it. Look at the structure. You haven't done that. If you have done that, you know when we talk of net income, what it means at what time. Melissa.
Yeah, that piece, it's revenue minus expenses.
Anybody else? Yeah, George.
Please, it's rather subtracting the expenses from our total revenue. That gives us the net income.
Francisca.
Say is when all expenses and taxes are deducted from the sales.
How will you describe that?
So after everything, the sales, then you deduct or you subtract the cost of goods. So the cost of goods is the sale, the cost of goods sold.
If you pick a typical and you pick the statement of comprehensive income, you see those ones are labeled there. They are labeled. Is it profit after tax? Is it profit before tax? Those are the issues that you should look at. It means that you have not read. Yes, Bismarck.
So please, the net income is from the comprehensive statement and it's a profit after tax.
Okay, so why should we use profit after tax when we're computing return on assets?
So because we want the actual position of the company, the actual income of the company, not the gross income.
We're not talking about the gross income. This one. Okay, so when you make an investment, there are a lot of individuals that make an investment in a business. Some of them will make equity investments. So if you make equity investment, what are you entitled to? Yes, James.
Dividends.
Okay, so dividend. So dividend means profit because dividend is the distribution of profits. So if we look at the profit after tax, it belongs to the equity holders. Okay, it belongs to the equity holders because when we have profit after tax, it belongs to equity holders. It's a profit after tax if we do not distribute it as dividends. That becomes a retained earnings. And recollect that we say that retained earnings is part of shareholders' interest in the business. Now, so if you are using profit after tax, but you are using total assets, you recollect when we discussed the accounting equation. How did you define the accounting equation? How did you define accounting equation? Yeah, Bismarck.
So please, asset equals liability plus equity.
Okay, so asset is equal to liabilities plus owner's equity. All right. Now, so if we say assets, then it means it's total assets. So total assets is equal to liabilities plus owner's equity. So in this, if that is our definition, then it means when we are doing return on assets, it could be net income over liabilities plus owner's equity. But the explanation that I gave you, the profit after tax goes to the equity holders. So it means that it will be a mismatch if you use total assets and you're looking at profits that is attributable to equity holders. So it means that if we define net income as profit after tax, then it means it's a mismatch because the profit after tax belongs to the equity holders, and yet we are dividing it with, or the denominator as shareholders' equity and liabilities, or liabilities and shareholders' equity. So it means that it's a mismatch. And therefore, we cannot use profit after tax. If we are using profit after tax, then it should be return on equity. So our definition for return on equity, income and return on equity, will be profit after tax. And we cannot use the same profits when we are looking at return on assets, because the assets are financed by both equity and debt. So why would you want to use profit that belongs to only equity holders, but you're using a denominator that combines equity and liability? So it means we cannot use that. So in your own mind, if you invest in debt, what are you entitled to? If you invest in debt, what are you entitled to? Yeah, James.
Interest.
Interest. Okay. So if you look at the liabilities portion, what they're entitled to is interest. But if you are using profit after tax, it means you are keeping out interest. And that makes it a mismatch. So if you're looking at return on assets, then probably, if you're using total assets, there should be profit before interest and tax. So our definition of net income here will be profit before interest and tax. Is that okay? Our definition of net income when it comes to return on assets will be profit before interest and tax. Is that okay?
Yes, sir.
Okay, all right. So remember that our definition of net income when it comes to return on equity is profit after tax. But our definition of net income or net profit when it comes to return on assets is profit before interest and tax. So as I explained to you, if you're doing the ratio analysis, once you choose the ratio and you look at the variables must be defined. Because you have to ensure that you are measuring exactly what you want to measure, and not because there's a name for it, you measure different things. So if you use net profit after tax in when you are computing return on assets, then it will not be a useful measure. But if you look at some of the computations that are done and published, in the annual report, you see they're using profits after tax, which is not a true measure. Yes, Matilda.
Sir, please, I need a little explanation on the profits before interest. I don't understand the interest part.
Okay, so one of the expenses that you will see in the determination of profits will be interest expense. Now, the interest expense is paid to providers of capital. Okay, so those who are not part owners, their compensation will be interest. Those who are owners of part owners, their compensation will be dividend, which is the declaration of profit. So their compensation is the profit. And we are saying that total assets is the same as owner's equity plus liabilities. So if total assets is owner's equity plus liabilities, then why are we using profit after tax, which belongs to only equity holders? So if you're doing a proper measurement, once you are using owner's equity plus liabilities, then you should bring the compensation to owners and bring the compensation to debt or liabilities, which is interest. And that's why we are using profit before interest and tax. Is that okay?
Yes, please.
So because you have not looked at the pattern, that's why it's like a maze to you. If you have looked at the income statement or statement of compensation, these issues that we are talking about would have been easier for you to comprehend. Any other question? Okay, so remember, we also talked about the margins, and I said that the margins, there are two of them, the net margin and gross margin. So what we have on the screen is the net margin. But remember that the margins are also measured in percentages. So the gross margin is gross profit or gross income over net sales times 100. And net profit margin is net income or net profit over net sales times 100. This we discuss under the vertical or common size analysis. So we'll use the same explanation for the margin. So if there are two entities, remember you can do an inter-firm comparison, you can do an intra-firm comparison, and you can do industry. So the one that is returning high net margins or gross margin is that to be have done better. Then the asset turnover, as I explained to you, is how you are using your asset to generate sales. And it is measured a number of times. So if we compute it and it is 5 times, as against an entity that is 2 times, then the entity that is able to use this asset to generate sales 5 times is considered more profitable because they are going to generate more sales and they can now cover their expenses. So then we have return on equity, and here remember we say that the denominator is shareholders' equity. So we are looking at what belongs to equity holders, and because of that, we should look at profit that is attributable to equity holders. So our net income definition here will be profit after tax. Any questions? All right. The next is to evaluate activity. And remember, we said that activity ratios may also be referred to as management efficiency ratios or efficiency ratios. And basically what we are looking at is how the resources are being managed. So activities are driven by management, and because they are driven by management, then that's why we say it is management efficiency ratio or efficiency ratio. So it's a number of activities that are undertaken, which will accumulate in either retaining certain profitability or showing some level of liquidity. So when we look at the activity ratio, they may be used to explain why we find ourselves in some profitability situation or why we find ourselves in some liquidity situation. So we can use activity ratio to reinforce our arguments as far as stability is concerned or liquidity is concerned. Now, some of the activity ratios are rate of stock turnover, average correction period, average payment period, and fixed asset turnover. Now, when we talk about rate of stock turnover, we are looking at how or the number of times that when we buy our stock, we're able to sell it. So we look at the number of times that we are able to sell our stock when we sell it. And we measure it by dividing the cost of sales over average stock. So we measure the rate of stock turnover by dividing cost of sales by average stock. An average stock is a simple average of opening and closing stock. So opening stock as closing stock divided by 2. So that will be an average of the stock levels, opening and closing. However, when we know of only one of them, i.e., if, for example, we know of only the closing stock, then the closing stock will be taken as the average. But it will not be 0 plus the closing stock divided by 2. That's not what we do. We do a simple average. But where one is known, then that is what is used. Now, I've mentioned to you that we're using the opening and closing stock. So if we are in 2020, how can we get the opening stock? If we are in 2020, how can we get the opening stock? How can we get the opening stock? I'm asking you a question. Yes, Benson.
You get it by bringing closing stock of 2019 to the 2020 as our opening stock.
So if we have the statements, where can you get that from? From which statement can we get that from? And from which year? Yeah, Bismarck.
So please, the balance brought down from 2019 is what we'll be using as our opening stock for 2020.
I said, where can you pick it from? Where can you pick it from? Where can we pick it from? Which statement can we pick it from? And for which year? We know it's 2019 closing stock because it's 2019 closing stock that will become the opening stock for 2020. But where can we get it from? If you are computing it, where will you get that from? Yeah, Bismarck.
So please, from the financial statement.
Which financial statement? With financial statements. Inventory account. So the inventory account, is it part of the financial statement?
No, please.
Yes, James.
The asset part of the financial statement.
Okay, we are going to end the class here. What the way to take the financial statement and review it and look at how these questions that I'm asking you, who you can pick it from. You can't come and sit in the class blind. You can't come to the class and because the simple questions that we ask you, you are unable to answer. It means that you have not really come to terms with the kind of work that we are doing. And when we keep on simple questions you're unable to answer. For 5 minutes, you can't tell us where we can get the closing stock from, where we can get the opening stock from. No, that is not acceptable. Any question? So go and review them, then we'll meet in the next class. Next week. Yes, this man, you have a question?
Yes, sir. Sir, please, with the videos, the lecture videos, we are not able to get them. So sometimes we are not able to even revise on what we did in.
Any other question?
Yes, please. But with the assignment, how are we submitting it? Through a mail or on Saturday?
The class rep. It must be given to the class rep by 2 o'clock. And the class rep should send it to me by 3 o'clock today.
Yes, please. Thank you.
So thank you for coming. Bye-bye.